Most traders do not blow up because they lack charts or clever indicators. They blow up because the market exposes how they think. If you have ever watched a green candle turn your plan into panic, or a small red number turn into a crater, this episode is for you. We are going to rebuild how you approach every decision you make with money on the line. No hype, no magic system. Just the 4 mental skills that separate survivors from tourists. You will learn to think in probabilities, to accept uncertainty without freezing, to use patience as a weapon, and to keep promises to your process even when your emotions protest. By the end, you will not predict the future. You will stop needing to. Your goal becomes survival first and profit second, so that time and consistency can finally work for you. Keep watching and bring a notebook, because we will turn ideas into daily habits you can start today. If you have failed before, good. That pain can fund better choices starting right now. Stay with me. I am not here to sell you certainty. I am here because I have spent years watching traders win for a while, lose it back, and finally learn to respect the math and the mind. I have reviewed thousands of trade logs, sat through market shocks, and studied the habits of consistent performers. The patterns are boring on purpose. They use small edges, strict risk limits, and repeatable routines. They do less, not more. That is the credibility that matters, not a screenshot from a lucky week. Here is my promise. If you follow the principles in this episode and practice them with honesty for the next 90 days, you will change how you trade and how you feel while trading. You will know exactly what you are allowed to risk. You will know what edge you are trying to express, and you will stop hunting for a magic signal. You will still have losing days, and that is fine, because you will have a plan that survives them. Your account becomes a tool for learning rather than a scoreboard for your ego. You will be calmer, slower, and smarter in execution. You will think like a builder, not a gambler. That is mind over markets in action. Start today with small risks, clear rules, and only honest daily reviews. Here is the core reframe. Trading is not fortune-telling. It is the repeated execution of a small statistical edge while protecting yourself from ruin. You do not need to know what the market will do next. You need to know what you will do in every situation that matters. A trade is not a statement about your intelligence. It is a test of a hypothesis under rules you wrote in advance. You define risk before entry. You accept that loss is a business cost. And you measure your results by expectation over many trials, not by the outcome of one trade. This shift changes your identity. You stop being a predictor and become an operator. Operators care about process, capacity, and safety. They prepare, they act, and they review. They do not chase. They let the math work by removing chaos from their own behavior. In practice, this means smaller position sizes than your ego wants, wider sample sizes than your patience prefers, and calmer reviews than your fear demands. It means consistency in rules and flexibility in expectations. You plan the trade, you place the trade, and you let the plan end the trade. The reframe is simple: survival first and profit second. Process over impulse. Probability over certainty. When you adopt this lens, you remove the need to be right today so that you can be profitable over time. That is how professionals think, and it is available to you starting now. Begin with one small change. Probability thinking means you stop trying to be right on each trade and start managing a positive plan across many trades. Most traders attach their identity to the next outcome, so they chase entries, move stops, and add to losers. That is accuracy worship, and it is expensive. Professionals think like the casino. The house does not care about one spin. It cares that its edge shows over thousands of spins. In markets, the edge is your tested setup plus strict risk and position sizing rules. The math behind this mindset is simple. You do not need a high win rate to make money if your average winner is larger than your average loser and your losses are capped. That relationship creates positive expectation. Expectation only reveals itself across a sufficient sample size, not across a handful of trades. Variance will cluster wins and losses in ways that look meaningful but are not. A 5-trade losing run does not prove your edge is gone. It proves randomness still exists. Most retail traders fight variance instead of working with it. After a loss, they double size to get even. After a win, they feel invincible and break rules. Both reactions destroy the expectation curve. Probability thinking breaks that cycle. You decide the maximum you can lose before the trade begins, and you accept that loss as the fee you pay to see the outcome. You never add to a losing position outside your plan. You never move a stop just to avoid pain. Build small habits that force the math to work. Track each setup separately by name and context. Record sample size, win rate for that setup, average reward measured in risk units, and peak to trough drawdown. Review weekly and ask if the sample is large enough to trust. Pre-commit daily and weekly loss limits that stop you from digging deeper holes. Close the platform when the limit hits. Log every deviation from plan in a simple journal, and rate its severity. Aim to reduce deviations first and profits second. Control behavior, then results follow. Think like this. If your setup wins half the time and your winners average 2 times your risk while your losers are capped at 1 times your risk, your edge is real even with a modest win rate. You can expect to grow if you allow the law of large numbers to play out. This only happens if you size positions small enough to survive the cold streaks that are certain to appear. Small positions feel slow, but they keep you in the game long enough for the math to work. Write decisions before you need them. For each setup, define the context, the entry trigger, the invalidation level, and the first target. Confirm that the position size keeps the account level risk inside your preset limit. Only then press the button. During the trade, stop narrating the market and follow the rule you wrote. If price hits the invalidation level, exit without debate. If you scale out at targets, do it the same way every time. Your job is to remove improvisation from risk decisions. When results frustrate you, do not change the rules first. Change your behavior first. Reduce size, slow down, and increase review quality. Mark each loss as planned or unplanned. A planned loss that followed rules is the cost of doing business. An unplanned loss needs a root cause and a prevention step you can measure. Review your sample size. Many traders pivot after 20 trades when the data says they need 100 or more. If your drawdown reaches your safety threshold, step back, audit, and return with smaller size and stricter execution. The goal of probability thinking is peace and consistency. You stop taking each trade outcome as a verdict on who you are. You start treating outcomes as samples of a process you control. Your confidence no longer comes from the last win, but from the quality of your preparation and the honesty of your logs. The market will still surprise you. Variance will still sting. But you will respond with rules, not emotion. Over months, this calm stance allows your small edge to do its work and your account to grow without drama. Treat each trade as one ticket in a long series. Keep costs low, risks small, and let time collect your edge. That is how probability thinking builds lasting accounts. Comfort with uncertainty is the discipline of acting decisively while abandoning the fantasy that markets will ever feel predictable. The sooner you stop seeking perfect clarity, the sooner you can build rules that keep you safe when the next surprise hits. Uncertainty does not mean chaos. It means you design your process so that unknowns cannot take you out of the game. You do this by sizing positions so that any single loss is small. by placing stops where your idea is proven wrong, and by accepting that a planned loss is a routine cost. You cannot remove uncertainty, but you can remove fragility. Think of three realities. Regimes change without an announcement. Price can gap through levels. And liquidity can vanish when you need it most. If you deny these truths, you will trade too big, hold too long, and say it will bounce until it does not. Instead, speak in probabilities and prepare paths. Say there is a moderate upward bias if these conditions hold, and accept that the market can still do the opposite. You are not predicting the next candle. You are defining what you will do if price behaves one way or another. Create scenario maps before you enter. If price reaches your level with momentum and broad confirmation, you take the trade at your planned size. If price reaches your level on thin movement near news, you either reduce size, delay, or skip. If price invalidates your thesis, you exit without debate. These if-then rules turn uncertainty into a set of rehearsed actions. Practice the boring safeguards. Use fixed fractional risk per trade so that a series of losses does not compound into disaster. Place hard stops in the market when slippage risk is acceptable, and use alerts plus manual exits when liquidity is thin. Do not stack correlated positions across the same theme unless your plan accounts for combined risk. When a currency peg breaks or a small cap stock halts and reopens lower, correlation becomes 1. Your job is to ensure that even a sharp gap only dents your account rather than erasing it. Diversify your approach across strategy types, timeframes, and instruments that you understand. You do not need 10 systems. You need a couple that behave differently when volatility changes. For example, pair a mean reversion setup that likes calm sessions with a breakout setup that likes range expansion. When one struggles, the other may carry the load, and your equity curve becomes smoother. Run drills like an athlete. Write 3 shock scenarios and your exact response for each. Imagine a sudden drop on no news, a news-driven spike that reverses fast, and a slow grind that tempts boredom trades. For each, define how you will protect capital and when you will step aside. Then trade smaller for a week while you practice those exact plays. The goal is to make your reactions automatic so that fear does not write your decisions. Accept that surprise is a feature, not a bug. The franc shock in the middle of the last decade was a reminder that price can jump past any line. The flash moves in indexes showed how liquidity can vanish and then return within minutes. Some disciplined traders survived and even thrived because they kept size small, honored hard exits, and refused to widen stops in hope. They did not know what would happen. They knew what they would do. Mood management is part of this mindset. Uncertainty is stressful when your identity is tied to being right. Detach your worth from the last outcome. Start each session with a brief check. Are you rested, focused, and available for a full review after the close? If not, cut size or do not trade. A healthy state reduces the urge to force clarity where none exists. During live action, keep your language neutral. Replace it "will rip" with "if it confirms and meets my rules, I will participate." That single word "if" keeps you in operator mode. Measure progress with behavior metrics that reflect comfort with uncertainty. Count how many trades you skipped because conditions were not right, how often you stuck to your stop, and how many times you reduced size near major events. Celebrate correct non-actions as much as winners. The right no keeps you funded for the right yes. When results feel random, fall back to your process. Tighten size, increase selectivity, and extend the time between reviews so you evaluate meaningful samples rather than noise. Uncertainty remains, but it stops being scary when your rules absorb it. Your account becomes resilient. Your mind becomes calm. You are no longer the person who needs to be right. You are the person who is ready. Strategic patience is the art of doing less on purpose so that you can do the right thing at the right time. Most losses are not caused by a bad idea, but by a good idea taken at the wrong moment or taken in the wrong state of mind. Patience removes rushed entries, boredom trades, and fear-driven exits. It gives you room to let the edge show. Think like a sniper who spends hours waiting and seconds acting. You create conditions where action is rare, deliberate, and measured. Start by defining what perfect looks like for each setup. Write the market context, the trigger, the invalidation, and the target logic. Then write a readiness check for yourself. Are you rested, focused, and free from outside pressure? If one box is not ticked, you do not trade. Next, design no trade zones. Do not trade the first few minutes after the open if your plan struggles there. Avoid entries directly into high-impact news. Skip midday if volatility is dead and spreads are wide. Guard your capital by guarding your attention. Give your setup space. Do not force price to your plan. Let price reach your levels with the posture you defined. If the context is off by one element, you pass. Passing is not weakness. It is what lets you be ready when the alignment returns. Use time boxes to prevent restless clicking. For example, review charts on the hour, then step away. Do not hover and invent a reason to act. Put friction between you and the button. Patience includes managing the urge to chase. When price moves without you, say next instead of now. If your entry is gone, let it go. A late entry with poor risk location is a tax on pride. Your job is not to catch every move. Your job is to keep your average trade quality high. Over 100 trades, missing even a great run matters less than avoiding 10 low-quality stabs. Measure patience like any other skill. Track the number of trades you skipped because rules were not met. Track the percentage of trades that fit all criteria versus partial fits. Track how many times you waited for confirmation instead of guessing. Celebrate correct inaction in your review. It feels odd at first, but it shifts your identity from hunter to curator. Build routines that make patience automatic. Pre-select your A setups and archive the rest. Set alerts at levels and walk away until they fire. Limit yourself to a fixed number of decisions per session. When you reach the limit, stop unless an A setup appears with full confirmation. Use a timer for cooldown after a loss so you do not jump back in. Choose quality over activity every day. Patience protects the mind as well as the account. Quiet sessions recharge attention for the moment that matters. When the clean setup appears, you will have energy and clarity to execute. Over time, strategic patience makes your equity curve smoother, your stress lower, and your confidence stable. You become the trader who waits, who acts rarely, and who keeps more of what you earn. The market will keep offering noise and temptation, but your edge will grow every time you say no to average and yes only when preparation, context, and price work together in alignment. Process discipline is the habit of keeping promises to your plan when markets are noisy and emotions are loud. It is the backbone that holds the other mindsets in place. Without discipline, even a good edge leaks away through small errors that pile up. With discipline, you do the right thing at the right time even when the last outcome hurt. Start each session with a short routine that sets direction and limits. Read your plan out loud. Confirm the economic calendar, your allowed risk per trade, your daily and weekly loss limits, and the setups that are active today. Write your if-then rules for the day in simple language. If price reaches level with confirmation, I will enter at size. If price invalidates, I will exit with no debate. This removes improvisation before it can appear. Create checklists that you actually use. one for readiness, one for setup quality, and one for risk. Readiness asks about sleep, focus, and emotion. Setup quality asks about context, alignment, and location. Risk asks about stop distance, size, and combined exposure. If any list fails, you either reduce size or stand down. The job is not to trade. The job is to execute only when the conditions are present. During live trading, keep your attention on process markers you can control. Speak in simple cues. Plan the trade. Place the trade. Protect the trade. End the trade. When nerves rise, slow your breathing and look at the checklist. A calm body supports a calm mind. After the session, review with honesty and structure. Tag each trade as planned or unplanned. Score execution with a simple scale. Note the trigger, the context, the reason for exit, and any deviation from rules. A deviation log is your mirror. Keep it brief and blunt. Then write one small correction you can implement tomorrow. Discipline compounds through tiny repairs, not heroic vows. Protect yourself from drift with accountability. Share your plan with a partner or with your future self through a weekly letter. On the same day each week, answer the same questions. Did I follow risk limits? Where did I break rules? What will I change next week? Keep the letter short so you actually do it. Define a break glass protocol for stress and drawdown. When losses reach your guardrail, cut risk to a token size. Move to half speed. Trade only your A setups. If you feel tilt, stop for the day. A small stop is wisdom, not weakness. Automate anything that reduces decision fatigue. Use alerts at levels. Pre-write orders in a simulator before the open. Hide the watchlist names if they trigger bias. Keep charts clean so you see what matters. Close social feeds during active hours. Protect your attention like capital. Discipline is not punishment. It is freedom from the loop of fear and hope. It turns trading into a set of simple promises that you keep. Over weeks, the noise in your process fades. Your edge shows up more often. Your losses stay small. Your confidence grows because it rests on behavior, not luck. That is what it feels like when process discipline becomes your default. Build an identity around clean execution and honest review. Track a small daily score for rule adherence, risk respect, and patience, and improve it weekly without chasing profits or forcing trades. Here is where we bring it home. You do not need a perfect system. You need a small edge, strict risk, and the 4 habits you learned today. Think in probabilities, accept uncertainty, practice strategic patience, and keep promises to your process. Start tiny so that mistakes are survivable. Pick one setup, define the risk, and run a 1-week experiment with honest reviews at the end of each day. Use the patience checklist before entries. Track every trade in an edge tracker with win rate, average reward to risk, and rule deviations. Protect your attention. Close distracting feeds during active hours. Celebrate correct non-actions along with clean exits. Progress is behavior first and profit second. If this episode helped, subscribe and share it with one trader who needs steadier rules. Download the free checklist and tracker linked in the description and keep them on your desk. Join the 5-day patience sprint starting next week. Each day, you will practice readiness checks, pass on marginal setups, and record what you learned. Leave a comment with one rule you will keep this week and one habit you will drop. I will read and reply to as many as I can. Mind over markets is about building durable skill. We do not chase certainty. We build calm strength through repetition and review. Trade small, follow your rules, and let time reveal the edge you already have. I will see you in the next session. Bring a notebook and start today.